Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Hey, Prime investors, Martin Maxwell here. Welcome back to the 5-Minute Prime Podcast. Same house, same loan, same rent, 2 different retirement accounts, and only one of them gets a tax bill. A few months back, I walked you through buying a rental inside a self-directed IRA. 4 steps, 3 traps. The third trap was the tax on borrowed money, and I handed you a one-line fix. Buy all cash. No debt, no tax. That fix works. It's also the half of the answer that costs you the most, because it caps every deal you'll ever do at whatever your account balance happens to be. So today, I want to give you the other half. Here's the machinery underneath the trap. When your IRA borrows to buy a property, the IRS doesn't tax your rent. It taxes the share of your rent that the borrowed money produced. The code calls that unrelated debt-financed income. On the forms, you'll see it as UDFI. And the share is just a ratio, average debt over average basis. Make it concrete. $300,000 rental. Your account puts in $150, borrows $150. Debt is half your basis, so half of your net rental income is debt financed. And that half is taxable inside the account that was supposed to be the shelter. And it doesn't stop at the rent. When you sell, that same ratio follows the gain. Except on a sale, the code doesn't use your average debt. It uses the highest balance the loan hit at any point in the 12 months before closing. Sit with that one. It means paying the loan down right before you sell buys you nothing. If you want that ratio lower on the way out, the paydown has to happen more than a year ahead of the sale you haven't listed yet. Most people find that part out at the closing table. Now, here's the part almost nobody gets told. Congress wrote an exception. It's in Section 514, subsection C, paragraph 9. And it says this: for a qualified organization that borrows to acquire or improve real property, that debt is not acquisition indebtedness at all. No acquisition indebtedness, no debt finance share, no tax. So who counts as a qualified organization? The statute prints a list: educational institutions and the organizations that support them, certain title holding companies, church retirement income accounts, and this is the one, trusts that qualify under Section 401. A solo 401k is a Section 401 trust. Now read the list again and notice what isn't on it. An IRA is a Section 408 account. 408. It's not there. Same house, same loan, same rent. The IRA files a 990T and pays. The qualified plan may file nothing at all. I call this the wrapper rule, and I want to say it plainly because it inverts how most people think about this. The deal doesn't decide whether your leverage is taxable. The wrapper does. And you pick the wrapper years before you ever see the property, which raises the obvious question. Can you move? Sometimes. And this is the practical part of the episode, so stay with me. To have a solo 401k at all, you need self-employment income and no full-time employees other than a spouse. That's the gate, and it's a real one. But if you clear it, a traditional IRA can generally be rolled into a qualified plan. Not every account and not every dollar. A Roth IRA can't go into a 401k at all, and after-tax money has its own rules on top. So this is a check-first item, not a do-tonight item. For a self-employed investor sitting on a traditional IRA and a property they can't buy outright, though, that rollover is the whole ballgame. The constraint is eligibility, not appetite. And if you don't have self-employment income, this path just isn't open to you. In which case, the honest answer really is the all-cash math. And I'd rather tell you that than sell you a workaround that doesn't exist. Now, this is an exception, not a loophole, and it carries conditions. Same paragraph, subsection B. The purchase price has to be fixed. The payments can't swing with the property's revenue or profit. You can't lease it back to the person who sold it to you. If a partnership is holding it, the partnership has to clear something the code calls the fractions rule. And you can't take seller financing from, or a guarantee by, someone the code calls a disqualified person. Which brings me to the part that ends accounts. Both of these accounts live under Section 4975. That's the rule that governs who your retirement account is allowed to deal with, and the list of people it can't starts with you. In 2013, the tax court decided a case called Peak. Two investors used their IRAs to buy a business. The lender wanted a personal guarantee. They signed it. No money moved out of those accounts. They just signed. The court held that the guarantee itself was an extension of credit between the plan and a disqualified person. Prohibited transaction. And when an IRA commits one, the code doesn't fine you. The account stops being an IRA. Not the deal, the account. Everything in it. And what that means in cash is that the whole balance gets treated as distributed to you. Every asset in there. Taxable that year, with an early withdrawal penalty stacked on top if you're under 59.5. Over a signature on a loan you were told was non-recourse. That's why financing inside a retirement account has to be genuinely non-recourse. The lender's only remedy is the property. You're not on the note, not on a guarantee, not anywhere. And non-recourse costs something. Fewer lenders write it, the leverage they'll write is lower, and it prices above what you'd pay on the same property outside the account. Honestly, the lower leverage part I'm fine with. That's roughly where I've been telling you to sit anyway. But price it before you count on it, not after. And if you already bought all cash inside an IRA because that's what you were told, you didn't make a mistake. You made the safe move. The only question is whether the next one goes in a different wrapper. Here's your challenge tonight. Pull up your retirement plan document, the actual document, not the custodian's brochure, not the website. Find the sentence that names which code section your plan is qualified under, 401 or 408. It's in there. Then what? If it says 401, get a non-recourse quote before you fall in love with the property, so you know what that exception really costs you. If it says 408, run two numbers side by side. The all-cash deal your balance can actually buy today, and the leverage deal with the debt-financed share taxed out, and let the spread pick. Let me make that concrete because it usually surprises people. Say the account holds $150,000. All cash, that's one property at $150,000. Levered, 50-50, the same money reaches a $300,000 property, twice the asset, and roughly half the net income comes back taxable. So you're weighing all of a small property's income against most of a bigger property's income, minus what the non-recourse loan costs you. Which side wins moves with how much bigger the property is, what that loan price is at, and what bracket the account lands in. There's no rule of thumb here. It's a calculation, and it's yours. Run it. 3 things genuinely need a professional before money moves. Whether a specific person is disqualified, whether the structure you're planning counts as an extension of credit, and whether your particular plan document actually reaches that exception. Get those 3 right, and the rest of this is arithmetic. The account is the decision. The property is just the paperwork. I'm Martin Maxwell. This has been the 5 Minute Prime Podcast. I'll see you next episode.